To all our viewers from the United States, Korea, and around the world, welcome to Global Money Talk by Sampro TV, live from the floor of the New York Stock Exchange. I'm your host, Remy Blaire, and you are watching our live broadcast from the financial capital of the nation in New York City. We'll begin the hour with the market briefing and live coverage of U.S. markets, and then we'll bring you market insights for an in-depth conversation with a market expert. Today for the market briefing, we have Tai Wong, independent proprietary trader, so make sure to stay on for the entire show because for market insights, we'll be welcoming Dan Ha, co-founder and portfolio manager of Karani Asset Management. Tai, happy Monday. Thank you so much for joining me.
Always good to be here.
Well, first and foremost, we're seeing U.S. markets higher, but this does come after the sell-off we saw on Friday. So I think it's a good time to do a quick market check as we kick off today's show.
Yes, absolutely. So I think we had some good news over the weekend, specifically about Boeing, which we'll get to a little bit later. But if we look at the markets right now, the equity markets certainly seem a little chippier this morning. Dow Jones up about 1%. 27 advancers down, only 3 stocks declining, and the S&P 500 up 0.6%, with a vast majority, about 440 of the stocks up so far this morning. The Nasdaq is up 0.5%. So the equity indexes look fairly good. We also let's have a look at fixed income. Fixed income is really interesting because I think we mentioned on Friday that the stock market took the employment report relatively poorly in that it wasn't weak enough to give them a 50 basis point cut. So the stocks that you mentioned were down substantially. But then the bond market seemed relatively happy about it and rallied reasonably strongly. So the treasury curve is just up a little. The yields are backed up a little bit, 2 basis points in the 2-year, which is at 367. I think that may be a little bit overvalued in terms of, do we really think that Fed rates are going to come down that quickly? So I like to think a little more, figure out a little bit more of what the bond market's thinking. The other thing I might add, and it started last week, but you definitely see it today, is the 2s and 10s. The market is no longer backwardated. The 10-year yield is 4 basis points above the 2-year yield, so we're back at sort of a normal yield curve, and we'll have to see how long that lasts.
Well, Tai, as you mentioned, that jobs report that we got out last Friday, headline non-farm payrolls coming in below expectations, but still above 100,000. And we also saw unemployment fall to 4.2% in August from that 4.3% we saw the prior month. And when we think about market action following the release of that July jobs report, we saw that volatility on August 5th. So what do you make of the sell-off we saw, and are you convinced when we see this recovery in today's session, at least partial?
So, it's probably worthwhile to wait until how we close at the end of the day. If we can close with some strength, then I think market participants might think that last week the market just came back. They know seasonally September is often the worst month for stocks, and it was kind of a sell-off week. Concerns about the employment report primarily. But now, if it comes back, the market will breathe a sigh of relief and say, okay, maybe we don't get 50 basis points, but we'll get is 25 basis points and sort of a dovish directive. So I can imagine Jay Powell saying, if data continues to come in the way that we see it, we see room to continue to become less restrictive. And the market goes, okay, we'll just get a string of 25 basis points into eternity, almost, and the market can be pretty happy about that. So I think it's a sigh of relief, and we'll have to see how we end today, and then obviously we also have CPI later this week. Actually, it's a good time to take a quick look at the calendar. The calendar, economic release calendar, the week after payrolls tends to be very, very slow. But what we do have this week is CPI and PPI, and they'll be the last 2 big pieces of data that the Fed gets before their meeting that starts Tuesday and then ends on Wednesday next week. So CPI will probably give them. CPI tends to be relatively not that volatile, at least in recent months, and I think it will give the Fed or give the market some relief that everything is going according to plan. And we also have jobless claims, but now people are starting to really focus on the Fed next week.
And as you mentioned, Tai, as we head into the rest of this week, we get CPI data and PPI. And of course, given the fact that the Fed meeting is next week, as you mentioned, from the 17th to the 18th, the Fed officials are in a blackout period in terms of being able to speak and offer any insight into what they might be thinking for projections. But that also means that we will be getting that statement out from Powell next week following that meeting. And I'm sure you're going to be paying attention to the economic projections as well as the language coming out from Jay Powell.
Absolutely. The things that are most important is the what they call the dot plot, which includes, as you mentioned, the dot plot is part of the projections. The projections also say where they see unemployment, where they see growth. But the market will focus on the dot plot because they will want to see immediately how many rate cuts the Fed governors and local Fed presidents have put in for the rest of this year. Is it 2? Is it 3? Is it maybe 4? They're not going to get 4. But is it 2 or is it 3? And I think that will change the mood of the market substantially. The other thing that the market's looking for is, I think they were looking at 4.1 or 4.2 as of June as the end of year unemployment rate. We were already there, so do they take that higher? And then also, that'll be the first thing they look at, and then 2:30, the press conference, typically lasts 45 to 50 minutes, will be, what is the directive? Is it guarded? Or is it going to put the market at ease? So those are the two things that are really going to matter next week.
And Tai, it's quite amazing because at the end of last year, there were so many expectations heading into 2024 for rate cuts from the Federal Reserve. And here we are at the beginning of September. We have yet to see a single rate cut. So expectations are high, as you mentioned, so we'll have to wait until next week to see what happens.
Yes, and you're exactly right. The market loves to get ahead of themselves, or itself, I suppose. At the beginning of the year, it was, we're going to get 6, 7 rate cuts this year. And then in May, it was like, we're going to get no rate cuts this year.
Yes.
And now we're going to get 4 rate cuts this year. The market is sometimes, I think of it as an unruly adolescent, and it gets moody, and it gets happy and unhappy, and we will see in the fullness of time.
Well, I think that's a good analogy there, Tai, because if you think about teenagers, adolescents, and how moody they are, you've seen lots of market cycles, but they always say that without a crystal ball, you can't tell what's coming. And I think it's a good time right now to take a step back and look at the different sectors, at least for the major equity averages, because as of the end of last week, we saw the S&P 500 close up by 13.4% for the year, the Dow up by 7%. And when we look at the individual sectors for the S&P 500, we're seeing consumer services up by 13%, but interestingly enough, we're seeing IT and financials up by 17% as well. So tell us what's going on here, and it does seem like quite a divergence compared to a month ago.
Yeah, I think I think technology has been a big driver of the rally. I think there's still a lot of confidence in technology, though we've seen tremendous volatility in the big names like Nvidia and Broadcom that we looked at last week. They had pretty good earnings, but they fell a little short in the outlook, and the market sort of panicked a little bit on that Broadcom. I'm not sure that was really maybe worth looking at Broadcom right now. Where is Broadcom? Let's have a look.
Yeah, let's take a look at Broadcom shares because we did see that major sell-off last week following their earnings report.
Can we get a live? Do we have a live shot of Broadcom? But while the team is trying to get that up, the market is still enamored. Certainly, the retail market enamored of IT. Financial services, I think, are getting a better reaction from the fact that rates look like they're going to definitely come lower, and they'll hopefully loosen up some of the things that are clogged up in the market. So financial shares, I think, when rates are high and economic activity isn't as strong as it normally is, you're not going to get that as good a reaction. So I think you're seeing part of that in terms of financial stocks.
And when we take a look at some of the big tech names that sold off last week, right, we had NVIDIA, they had a major sell-off at the beginning of last week, and that was quite a significant amount in terms of market cap being wiped off. But what do you make of where we are with those big AI tech plays right now?
So I can't quite decide, and of course, maybe the audience isn't quite looking for that, but if I look at NVIDIA, they had a good report. They had some problems with one of their big chips, but looks like they should be able to iron that out over time. And what you're seeing is it's having trouble at the 125 to 130 area, and it's backing off, and it's holding around the 100 area. And I think the market is looking for what's the outlook going to be, and I think the Fed will help us with that in terms of, do we see an easing Fed, a happy Fed. We like where we are, and we'll get growth again. And so NVIDIA, will continue on a new upward trajectory. And the same thing with Broadcom. I mean, I see Broadcom's down a bit today as well, and I think perhaps we're not going to get resolution. There you go. It's down 1.4%, and I've been thinking about Broadcom and thinking, is there good value here? I think this is a really good name, one of the top 10 stocks by capitalization or very close, and just like NVIDIA, the field in front of it has good running room. But I think I need to see the market I need to see the Fed. I need to see how the market feels about the market overall going forward, because I think this is the beta is going to be close to where the market is. If the market's happy, I think these will continue to go up, and if not, it may be a little bit problematic. So I think there may be value here, but give it a week. I want to see how I want to see this next week.
Well, we'll keep our eyes on price action for Broadcom as we head into the rest of this week. But before we move away from the tech sector, all eyes are on Apple today, especially ahead of their event taking place in California. So that event is scheduled to kick off at 10 a.m. Pacific time, so that means 1 p.m. Eastern time here. And they are expected to announce product announcements as well as more insight into their Apple Intelligence capabilities as well as AI. So what are you paying attention to when it comes to that name?
I think you hit on it right there in terms of where is the next growth driver going to be for Apple, because in recent years they're functionally been a phone company. It really is the iPhone that drives everything. But if they can get into anything into AI, anything into where AI can drive perhaps more sales or can drive more revenue and has a good outlook, I think that's what the market really wants to see. They'll usually have some new product or updated products. They'll be ready to ship for Christmas, but functionally it's still a phone company. But if they can show the market that they're moving into, have new advances, and they can take advantage of the AI or ride an AI boom, or certainly from the market's point of view, I think that's where they'll get the biggest bang for their buck. So we'll see.
Yeah, we'll see as we head into the afternoon what comes out of Apple. So they are expected to unveil their iPhone 16 with AI capability, as well as new versions of the Apple Watch, as well as their AirPods. So that could mean lower prices for their current lineup of products out there.
Right. They'll usually cut their prices a little bit. I just had to buy a new iPhone for my daughter, an iPhone 15, because hers was 3 years old and the battery was starting to be not as good as it used to be. But I'm just really glad that they have the USB-C charging cable now.
Yes.
So it's I think a little more of a reliable cable. And it's the same cable that I use, so she can always borrow mine.
Well, I think Apple iPhone 15 is quite advanced. I'm still on 13, but perhaps I'll upgrade this holiday season. We'll have to see.
Right.
Well, moving on now, Tai. So let's move on to see what's behind some of these market moves. So as you mentioned, we have economic data coming out later this week, but we will also be paying attention to other things as well. So in terms of what you're watching as we kick off this new trading week, do you want to enlighten our viewers?
So the thing that really sort of raised my eyebrows, the big story of the weekend maybe, at least domestically, is Boeing who's had a lot of trouble recently, has come to a 4-year agreement with one of their biggest unions for a 25% pay hike over a course of 4 years. That's a lot.
Yeah.
You know, I'd like to get a 25% pay hike over 4 years. That's a lot. And I think this was really important for Boeing because of all the trouble that they've had recently, from the 737 Max to nearly losing a door on the Alaskan Airlines flight. They didn't need any bad news, and I think the new CEO wanted to make sure that they were producing planes on time, making deliveries on time. So I think he needed this, and in addition, they promised to make a lot, some of the whatever the next generation plane is after the 737 MAX 9 in the Seattle area. Now, nobody knows when the next plane is going to come, but so that that's important. But 25% over 4 years, I think the union's going to approve this. The union leadership really likes it. I think it's one of the best deals they've had over some time. So if they don't approve this, and I think it's a low percentage chance, I think that'll be an issue. And I think if we can, Boeing is up, I think, substantially today. If we have if there's a live Boeing chart that we get. Boeing was leading a little bit earlier. So Boeing is showing up about 3% on the day. You don't see it right in the chart because it opened higher because of the news over the weekend. So Boeing was looking at the stock price. It's certainly well off its highs. I'm not sure if I'm quite comfortable buying it here, but I'm thinking about it because if you look at Boeing, I know they've had a lot of troubles, and there's some documentaries that showed that the focus of the company went away from the engineers and building great planes to better financial results. There was a great documentary with it. It was a little painful. They said it used to be the slogan, if it ain't Boeing, I ain't going, and people were laughing, doing a little bit the opposite of it. But it was a great American company. I think because there are not too many jet makers, really other than Boeing and Airbus, that Boeing has a certain sort of amount of armor in terms of they're going to get more support if there's trouble than they might otherwise, which is why I'm thinking, is there some value in Boeing here? I'm not as confident as I am perhaps in something like a Broadcom, but I think there may be value here. If not here, maybe another 5 or 10% lower. I think there may be value in Boeing. Sentiment was really, really down on the lows. I think this is turning sentiment a bit, so I'm thinking about it. It's on my list.
Well, between the management change as well as the way that the company has addressed some of the issues, we'll have to wait and see when it comes to this name like Boeing. So I understand that while we're on the topic of stories that you're watching, you've been paying attention to employment figures, labor market data, in particular what's happening with the IT sector. So what's going on here, and why do you think this is happening?
So anecdotally, the hottest thing in the market for years was software development. Everybody wanted to be a software developer, and I remember back in the old days, antediluvian period, when I was at Harvard, the most popular major, or concentration as we called it, was government or political science. Well, I think computer science overtook that as the most popular concentration probably 15 or 20 years ago, and remains so today. You couldn't lose in software development. But what we found, what I heard anecdotally from kids of people who went to church with me, and just other professionals in the market, is the kids were coming out of school and having trouble finding jobs. As a matter of fact, some kids who had offers, so some very big name companies in the Mag 7 to do software development, were asked to say, well, either had their offers rescinded or had said, take a year off and we'll hire you a year from now. And it was really kind of startling for these kids who thought that that software development was really the way the future, couldn't be beat. And this weekend, the Wall Street Journal reported that IT unemployment is actually at 6%. The overall unemployment rate is just over 4%. So that it's still a sector that's going through a lot of change. I think AI has made some of these jobs, perhaps perhaps redundant, perhaps less necessary, but it really sort of raised your eyebrows to say that this big driver of employment growth is actually at 6% employment. And there was a quote in there and saying if you're looking for a job, a really high-paying job in software development, think about it again. So a little sobering now I'm not saying you shouldn't learn to program. I think that's actually, for many reasons, especially if you want to get in financial markets, a great place to be. But it's not sort of the pass go and collect $200 as it was for some time, especially after the pandemic.
Yeah, and if you think about students who are set to graduate and they've been given an employment offer and that's rescinded, that can be really challenging and really tough.
I mean, that's just a shot in the gut. You paid, your parents may have paid $80,000, $90,000 a year. You have a job, everything's great, and all of a sudden, sorry, no job. I mean, I can't imagine, at that age, all of a sudden you're flailing a little bit. And speaking of some of these kids, they were a little concerned, a little upset. They're young, they're smart, they have a great skill set. They will find something, but that initial, sorry, that we have to, take back our offer is tough.
Absolutely, and I think a key term you mentioned there was AI, artificial intelligence. And you think about what's happening in that space and the demand for people who have that skill set to work in that industry. Some of the figures out there for even entry-level positions are, a good 6 figures, aren't they?
Sure. 6 figures or 6 figures with great benefits. Those are really plum jobs.
Yeah.
As plum as the investment banking internships, investment banking analyst jobs and the starting consulting jobs are. They're all equally sought after, equally prized.
And I'm glad you mentioned internships right there, because some of the internships right at these Mag 7 names, or of course in particular even non-public private artificial intelligence companies, the salaries, or shall we say the stipends that these students get for internships are quite staggering and might be above some of normal paychecks.
It is. As a matter of fact, I think a lot of these internships will pay you a prorated version of almost your starting salary just for those 2 months. And if you think of a junior, of the really gifted ones, a sophomore in college, and you're making, just say at $100,000, if you're making $100,000 a year for 2 months, you're talking a very substantial sum of money that the kids can really have a great time with their senior year.
Yeah, I know, and it's quite amazing, but I think that speaks to where we are in terms of the infancy of the artificial intelligence sector. And I do want to move on very quickly, since we're very limited for time, believe it or not. I understand that China's central bank, the PBOC, did not buy gold for the 4th straight month in August. Last week you were on the show talking about gold, its use case, its utility, and of course central bank holdings. So what's going on here?
So I think the People's Bank of China has been generally they're considered a very savvy market player, and I think they started buying in the 1800s. They bought all the way through maybe 2300, and I think they've said at 2500, it's not such an attractive add to our reserves right now. We have plenty of time. If it comes back down, we'll add, but gold has stayed relatively elevated, even though this is the 4th straight month they haven't bought. Market's bullish. I know that producers aren't hedging. A lot of producers are talking about, we're not going to hedge until it gets to $3,000, which makes me think maybe the 28 or 2900 will be the high, because unfortunately the target for producers sometimes doesn't work out. It'll top out just before then. So if I were a producer, I'd say your all-in cost for mining gold is probably somewhere in 1,000, 1,500, 1,500-ish range. At 2,500, you ought to be thinking about hedging.
And I'm glad you brought up the price of gold, because given that it touched record highs, even though the PBOC didn't increase their holdings, the value increased, right, of their total holdings.
Yeah, the value of their holdings is has gone up tremendously, because their average purchases over the past few years probably 2,100 or thereabouts. So we're at 2,500. It looks great on paper.
Well, Tai, we have to wrap it up. So before we let you go, we are continuing to see the major U.S. stock averages higher. The Dow up by 0.9%, the S&P 500 up by 0.6%, and the NASDAQ up by 0.4%. So Tai, as always, it's been great having you on, and we look forward to having you back on as we head into the rest of this week.
No, great to be here. Thank you.
Thank you so much. And coming up, we will be joined by Dan Ha, co-founder and portfolio manager of Karani Asset Management. Don't go away. Welcome back to Global Money Talk, live from the New York Stock Exchange, brought to you by Sampro TV. Now I am joined by Dan Ha, co-founder and portfolio manager of Karani Asset Management. Hi Dan, happy Monday, great to have you back.
Happy Monday, glad to be here, thank you.
Well, we are seeing the major U.S. stock averages rebounding today, trying to recover from the lows that we saw at the close on Friday.
Right.
And of course, the sell-off last Friday came on the heels of that U.S. jobs report. We saw non-farm payrolls come in below expectations,
right,
and a revision to the prior month as well. But we did see the unemployment rate in the U.S. drop from 4.3% to 4.2%. So what do you make of what we saw and this rebound we're seeing today?
Sure. So the jobs report itself, it kind of depends on who you ask. You're going to get different opinions. So last week, obviously, the number itself came in below expectations. So some would look at that and say that, while it was a disappointment to estimates, it was still a solid number. Some will say that, well, but it's the direction and the trend that matters. So even though the number itself was solid, it indicates a slowing job market. And like you said, some would point to the unemployment rate as well as the average hourly earnings, which ticked up a little, and unemployment rate ticked down just a little bit, and would look at that and say, oh, these are potentially bright spots. And there were also a lot of chatter around whether a 50 basis point cut would be considered in the September meeting, and people having different views about that 50 basis point cut. Some people were saying that the likelihood of 50 basis point cut after the report is probably lower, and most people are expecting 25, which some people interpret as a disappointment for stocks. And some people say that actually think that's a relief because a 50 basis point cut would have signaled that the Fed was seeing something much worse, and it would potentially spook the market. So, whatever the interpretation, whatever the interpretation, you're going to get, people are going to look at the same data, and 10 people, you ask 10 different people, 10 different people might have 10 different opinions, conclusions about it. But it's important to remember that, somebody's going to be right. We just don't know who, right? And when it comes to, predicting, when it comes to predictions, one of my favorite quotes actually comes from Lloyd Blankfein, who ran Goldman Sachs, and he said that, I'm in the risk management business. I don't care what you say. I don't care what you say. I don't even care what I think. I contingency plan. And so, I think it's important to remember that. But looking at the actual market reaction on Friday, clearly the market didn't like what it got. Otherwise stocks wouldn't be down. If you think about it, if the jobs report was actually better than most people's, if the job report was actually a good one, as some people suggest it was, then what that says is that the jobs report was good, but stock prices still fell, and that's not really good because that indicates that expectations are high. When you have good news and prices go down, that means expectations are too high. If the jobs report, was actually not so good and prices fell, what that tells me is that expectation was basically right where it should be, which also isn't that great because if we go back to what I said last week, what we like to look for are asymmetric risk rewards. Situations where it's heads you win, and tails you lose a little, potentially lose a little, and that means you want to be invested in situations where there are low expectations. And basically, the reaction of the market last Friday, regardless of whether the jobs report was a good one or a bad one, was down, which tells me that there are really no low expectations in the market right now. So, I wasn't last Friday. I wasn't necessarily quote buying the dip. We have some cash in the portfolio, but I wasn't really compelled to put that cash to work because I didn't like what I saw in terms of market behavior. That is not necessarily the jobs report. So I was kind of sitting on the sidelines.
And speaking of which, Dan, you said you have cash in your portfolio. So what would you have to see to put that cash to work?
Yeah, so for us, the level of cash is actually not a top-down asset allocation decision. It's really a function of the availability of the opportunities that we're seeing in the market. So if we're finding lots of really attractive opportunities, which we, like I said, which we define as asymmetric risk reward, where the outcome is skewed the range of outcome is skewed in our favor. If we're finding a lot of them, obviously a lot of those opportunities will be competing for room in our portfolio, and we would own them, and each would be a relatively small position in the portfolio. But right now we're actually running pretty concentrated positions. What that means is we like what we like, but we're not finding a whole lot of them. And when we have concentrated individual positions, we tend to hold cash to sort of protect the portfolio against the risks that come from having such concentrated positions. So, I can't say that I need to see some macro data points before I turn more optimistic. It's really the availability of the opportunities in the market, and just right now, we're not finding a whole lot, especially in terms of valuation. Last week I talked about wanting to focus on high-quality companies, and also paying attention to valuations. There's still plenty of high-quality companies, but it's the valuation part of the equation where we're struggling a bit at this juncture.
And Dan, you just mentioned high quality here, so can you explain what that actually means and set the context for that as well?
Sure. So different people define quality differently. So I'll use our definition. Our definition of quality is businesses whose future success is highly dependable. A famous psychologist, late Amos Tversky, once said that people think they can predict the future if they try hard enough. And John Maynard Keynes said that about the future, we simply do not know. So the future is very difficult to predict. Yet prices of stocks are a function of the future of that business. So as investors, we have to think about the future and have to think about the range of potential outcomes in the future. So we want to stick to companies where we can reliably or we can depend on a projection of that company's future actually happening. So when we look at a company, we don't necessarily get excited about a potential growth rate of a company, but we get excited about the dependability of that growth rate of that company, even if it's a low growth rate. So those are kinds of the things that we're looking for, and in order to assess the dependability, in order to assess the risk reward of the business, you do have to have a reasonable, you do have to be able to have a reasonable degree of confidence in the future outcome of those businesses. Otherwise, it's impossible to weigh the risk rewards. Just in practical terms, for us, there are really two elements that we look at to assess the dependability of a given business, and those are really one, corporate culture of the company, and second, the competitive landscape in which the company operates in. So corporate culture is like the DNA of the company. It's the operating system. It really dictates how a company behaves. So if you can have a good understanding of how a company behaves today, driven by the culture of the company, you could have a pretty good sense of how that company is going to behave in the future. Andy Grove, who ran Intel to enormous success, said that culture is the way things are done here. So if you could understand the way things are done at that company, you could have a pretty good sense of how that company is going to behave, how the organization is going to behave in the future. And secondly, competitive landscape. Last week I talked about how you want to focus on companies that are very difficult to replace or replicate. So the tougher it is for a company to be replaced, or for a competition to replicate that business, the more certainty you can have about that company's success continuing on into the future. So that's how we define.
Yeah, and Dan, before I ask you for some examples here, can you give us a better idea of how you personally look at company culture of organizations? Because for retail investors who might not have access to information and they just get anecdotal evidence, how can you actually assess what a company or an organizational culture actually looks like?
Sure. That we get that question a lot, actually. So culture in and of itself is not just one thing. And you can't really measure culture, but there are aspects of an organization or any organization that tells you about the culture of that company that can actually be measured. So for example, if we're talking about a manufacturing company, something like safety statistics and comparing that against the industry peers or the history of safety of that company, that tells you that's a measurable thing, and that'll tell you about how the company thinks about safety of its employees at that company. So that is one way to take every aspect of the company and the organization really is a window into how the company, what the company's culture is. You could even look at, you could look at financial metrics or would be able to see, if you can see some sort of a pattern or a historical pattern of excellent capital allocation, for example, not taking on too much debt or not pursuing projects that are too risky for the business. And if you can see sort of a history of discipline, that tells you something about the culture of that company. And also in this day and age, I mean, you could obviously talk to your friends and family, that work at the company, or any given company that you're researching. But in this day and age, through social media and internet, you could actually find out a lot about how the employees of that company feel about working at that company. And the last thing I'll say is the rise of ESG has actually been favorable in this sense, because it has forced a lot of companies to disclose more and more information about their corporate behavior. So, if 20 years ago all they were disclosing were financial data, now more and more companies are voluntarily disclosing information about their behavior as a corporation. So those are some of the things that we look at to kind of pull all the pieces together. And then obviously at the end of the day, there is a lot of sort of art involved in trying to figure out what matters, because you're going to have to look at different things for different industries. And for any given company, like for instance, if a company has a CEO change, depending on the context, that might be a good thing or a bad thing for the culture of the company. So, there is a lot of art when it comes to figuring out what it is that we have to look at. But in terms of measuring and really using hard, figures and measures to assess the culture of the company, that is very much doable.
Yeah, and Dan, before we move away from this, since you mentioned ESG, there are different rating systems, and at least here in the U.S., there are different firms that publish ESG figures for the major companies. So we might be learning about the environmental, social, and governance factors of a company, and I'll just throw out a name out there because they've been in the headlines, and that is Starbucks. So the way they might treat their employees, so if they work for a certain number of years, perhaps they get benefits or tuition reimbursement, or how are they treated within the organization. I think it's really helpful to look at those ESG figures, but sometimes because there are different numbers that are published by the different firms, how do you know what to look at in terms of corporate culture?
Sure. So we think actually there are lots of ways you could look at this, but we think the number one truth teller is actually employee engagement and employee feedback. And there are different ways you could look into this, but it's hard to have a company with a really healthy culture where the employees really don't care, because they're disengaged, and they could get disengaged for a lot of different reasons, but whatever the reason is, when you're disengaged, that means you're not happy, and when you're disengaged, you're not really going to care. So I don't know if I'm sure you've had an experience, trying to get some help from, some customer service organization at a company, or in a store, and if you've dealt with an employee who just really didn't care, how was that experience? I'm sure it wasn't great. Right, I'm sure it wasn't great, and I'm sure a lot of us have experienced working in organizations where after a while you said, you know what, I'm just not even going to speak up and express my views because they don't do anything about it anyway. So why should I bother? It's kind of impossible to have a company with a thriving culture of innovation and outdoing the competition when you've got a group of people who just say, well, I'll just do the bare minimum and collect my paycheck. So employee engagement is something that we think is the biggest truth teller, and we also try to actually match that with customer satisfaction, which is increasingly more and more available. So customer satisfaction data. We think it's pretty difficult to consistently have satisfied customers when the employees that serve that customer are consistently disgruntled and disengaged, and vice versa. Sometimes we see data points of companies that say that employees are really happy to work there, like best places to work. but the customer feedback data is really poor. So we like it the best when we actually see the two corroborate, and it's the strongest indicator, rather than relying on any one or two, ESG data source.
Yeah. Well, I think that's really important, and that's a very interesting insight, because you hear all about how data is important, data is king, but it's also important to be able to extrapolate and analyze some of that data. So, Dan, I do want to go back to some of these high-quality names. Can you provide some examples for us?
Sure. When it comes to culture being a predictor of behavior, you could think of a company like Costco, for instance. I don't know if you shop at Costco.
I have.
I shop at Costco a lot. Costco operates in a highly competitive industry of retail, but for some reason, over the decades, they figured out a way to consistently outdo and perform better than their competition. And Costco essentially does this by executing its philosophy almost religiously, which goes back to its founder. They have a pricing strategy that's been very, very consistent throughout the years. They only mark up their prices 14 to 15% of the price that they pay their customers. So sometimes, interesting thing about that is, rather than pricing to the market, pricing to where the other competition is pricing the product, they're always pricing it off of the price that they got, and they're just adding 14-15% on top of that to sell. What that means is sometimes you could actually leave some money on the table, because if a certain product is being sold at a much higher price at all the other retailers, you can just match that price. But they won't. If they got it for a cheaper price from their source, they're only going to mark up 14-15% and just give it to their customers at a lower price. And by doing that consistently over the decades, they build brand trust with the customers, who know that when they come to Costco, they're always going to get the best value. And so that's how Costco wins. And this kind of execution is really it's really the culture. It's being driven by the culture of the company. There's nothing really, no one piece of technology or a patent or something that protects the company from competition. It's really executing their strategy, the strategy that's been working for them. They're just very good at executing. And a funny story about that being consistent about their behavior and the culture is Costco recently got a new CFO who came from the outside. And Costco famously sells the $1.50 hot dog and soda combo, which they started back in the 1980s. And they haven't changed the price of that hot dog and soda combo since then. Famously, the founder of Costco said that if you ever change the price of this, I'm going to kill you, to whichever executive he said that to. And so they still sell it for $1.50 today. The new CFO, one of the first things that he promised when he came to Costco as a CFO was that the price of the hot dog soda combo is not changing. It's going to be $1.50. They could sell it for a much higher price, and it would still be good value, but they're not doing it. It's not about the money. It's really symbolic. It symbolizes the new CFO and the new CFO committing that he's not going to try to change things that has really worked for Costco. So that is an example of a company, where I could have confidence about the behavior of the company because of the culture of that company. And I'm very confident that Costco will continue to behave in the future the way it has behaved in the past. And just on the competitive landscape side, the example that I want to give is about a company that I think is extremely difficult to replicate, and it's a company. And that company is Hermes, the French luxury goods maker. I'm sure you know, but their bags are basically the most expensive leather handbags.
It's quite outrageous, isn't it?
Right, that money can buy. yet the business does really, really well. What's interesting about the ultra high-end luxury market is that customers don't respond to lower prices. It's actually the opposite. So in most industries, what makes competition really scary, a well-funded competition really scary, is that they'll come with money and they'll undercut you, they'll offer lower prices and take customers away and win market share and destroy you that way. That happens in most industries. It can happen in the highest end of the luxury products, because you can't, it doesn't matter how well funded you are, you can't price cut your way into prestige. In fact, if you're going to offer a cheaper bag that is just as good as Hermes's bags, but is a cheaper price, it's not going to be as desirable. So Warren Buffett famously said that even if somebody gave you or me or anybody $100 billion, we couldn't replicate Coca-Cola's business with money. Same is true with Hermes, in that even if somebody had $100 billion, you just simply can't buy your way into prestige. Prestige takes decades, if not in some cases centuries, to build. So the risk of some new brand showing up out of the left field over the next 5 to 10 years to really challenge Hermes's position, we think is virtually impossible. So that's an example of a company that whose future is, I think, pretty dependable, because it's just so difficult to replace it or replicate it.
Yeah, and I think those are very good examples, because here in the U.S., when it comes to a name like Costco, it's a fan favorite, isn't it? A lot of people go there, as you mentioned, for the hot dog soda combo deal, and whenever there's talk about Costco raising those prices, there is outrage across social media. Like, oh my goodness, we can't have that happen. And a lot of people go there for gas or cheaper bulk items as well. Yes, and I personally haven't set foot in Costco in many months, but I do have a few items that I'm planning to purchase next time I do go into that store. And a name like Hermes, so we're here at the New York Stock Exchange on Wall Street, and right outside is an Hermes location, and it's not that crowded, but we know, as you mentioned, that high-end bag, the Birkin bag. Sometimes when I talk about that with friends who are not familiar with just how expensive a Birkin bag can be, and let's just say it's made out of ostrich or crocodile skin, then it can go into the 6 digits, right? Yeah, and even for used items, the resale value is quite high. So I think those are very good examples that you provided, Dan. And why you said that you were struggling to find high quality companies at attractive valuations, can you tell us a little bit more about that?
So Costco and Hermes are actually perfect examples. I think their businesses are great. They're wonderful. And for full disclosure, my firm Karani, we own small positions in both companies in our portfolios, but we'd love to own them at much larger positions. But the valuations at the current levels are really just tough to justify, the potential risk. And it's important to remember that investing is both about selecting the right businesses, but also owning them at the right sizes. So that's why valuation really is an important consideration before you think about how much of your portfolio you want to own in those stocks. If we could actually pull up slide 1, I prepared a few slides to just show valuation. So this is the historical and present price-earning ratio of Costco. This goes back 20 years. And you can see that Costco's price-earnings ratio currently is at its all-time high, and by a lot. For the longest time, it sort of traded in the 20s and the 30s range, and in the last several years went up to 40s, and now it's in the 50s. So as much as I like the business of Costco and think they're wonderful, the culture of the company and their execution of the strategy, 54 is really very high. especially when the industry, the peer group, trades more like in the low 20s and sometimes in the high teens. So as much as I like the business, I just have to be cautious when it comes to owning too much of this. If we go to the next slide, please. Slide 2. So this is Hermes's price-earnings ratio. Similar story, but in this case of this company, the current PE multiple of about 45 trailing and 43 times forward earnings is actually not that bad relative to where the stock is traded in the past. Nevertheless, it's a high absolute number, and even though I fully accept that there are plenty of businesses in the market that deserve premium multiples for what they are, it's still a very high number. And the reason why this is important is because if for whatever reason, even though it's unlikely in my opinion, if they lose their prestige, say over the next 10 years for some reason, the market will probably start assigning a lower multiple for the company, which means that investors could buy a business that grows, but if the multiple gets cut, then your returns aren't going to be that attractive. And on this point, if we could actually just put up slide number 3, this is work done by Michael Malvison at Morgan Stanley, whose work I highly recommend, by the way, to anyone serious about investing. This shows that the earnings per share growth and PE multiple change have driven over 80% of the S&P 500's return over a decade's time. So finding companies who can grow its earnings per share, which is basically driven largely by the growth of the business, is very, very important. And equally important is not paying too high a price, because like I said, you could have a company that grows, that basically doubles its earnings per share over a 5-10 year period, but if the multiple gets cut in half because the market was actually expecting a triple or a quadruple growth of earnings, then even if the earnings double, you're going to be flat on your returns because the multiple got cut in half. So it's very important to remember that those two, earnings growth and multiple, really are the biggest drivers of equity returns. That's why such high importance, I think, needs to be placed on those two things.
And Dan, I think it was very helpful to see both of those charts and to see that contrast as well in terms of PE ratio. Well, we are heading into the final minutes of the show, and I do want to mention that we're seeing continued advance for the major averages right now. We're seeing the Dow up over 1%, up by 1.3% on the session, while the Nasdaq Composite Index continues to gain and is higher by triple digits as well, or 0.9% on the session. Meanwhile, the S&P 500 is also up by 1% and is up by nearly 60 points on the session. So very quickly, Dan, before we wrap up for today, as we head into the rest of the week, we do have key economic data releases, but since we're talking about valuations, what do you make of the price action that we just saw for the Mag 7 names?
Sure. So first of all, I don't really think about Mag 7 as sort of or those 7 stocks to necessarily be in the same group, other than to share a catchy description. Some of them, their opportunities, their valuations, their risk, have become quite idiosyncratic, meaning very company specific. So I think one needs to look at them really individually, but without going into every single individual names. What I will say is, I do have a strong preference for companies that have a high software aspect to their business. I've discussed in the past about the stickiness of the software businesses, and if you're selling essential tools to businesses and consumers, it's really very difficult to rip and replace. And not only is it difficult to rip and replace, it actually ends up becoming a very good distribution channel for further revenue gains or wallet share gains for these companies. So I have a strong bias towards companies with higher software aspects to their business. Now, all the companies in Max 7 are essentially in the technology area, so they all have some software aspects to their business, but certainly some more than others. So I prefer the more than not. And among those, you know, the lower the valuation, the better. Some have lower valuation because of some controversies around them. But you know, that's what creates good valuation and buying opportunities. So it doesn't bother me much.
Well, Dan, it was a pleasure having you on the show. We have the Apple event later today, so we'll see how that name performs.
Sure.
Thank you so much for joining me.
Thank you.
And that will do it for Global Money Talk live from the New York Stock Exchange. We're so excited to bring you daily coverage here on SamPro TV. You can check out the show anytime on our YouTube channel by searching Global Money Talk. Thank you so much for joining us, and we'll see you bright and early tomorrow. Thanks for watching.